Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Prime Revision Network. So today we have our EIA show, and we're going to go through the data and a lot of the other things that continue to happen. And then on the econ show, we're going to go deeper into some of the geopolitics on the Iranian side, Libya, and and Russia, in terms of what are some of the things that are happening, how that's happening. But it's interesting because when we break it down into our normal three segments, we're going to talk about a little bit on what another Biden SPR release would look like, because there's talk of another 15 million getting slated for movement from the SPR. And what does that mean? Like, where is the market right now? Is that going to be meaningful? And how would that shift things? And then we want to talk again, because it keeps coming up, on why a ban on refined product exports is a terrible idea, based on the dynamics within the country. When you look at the different regions, the pads, the production side, and where those shortfalls are. And then we want to look at how will OPEC and how has OPEC cuts changed the market dynamics, and if we're seeing a bit more of an offset, if you will, when you look at some of that slowing demand, and then Kazakhstan coming back into action. So getting right to the market in general, here you can see that the deficit narrowed from 27.7 to 23.1 when you're looking at total oil and product stocks. So when you look at crude stocks, you have to consider land and floating, with the surplus widening from 21.2 to 25.2. And a lot of that is being driven based on the floating going into the land storage, both of them remaining a bit more elevated, and a lot of this starting to get driven by China. So when there was commentary that India is no longer going to, or at least two of their largest buyers from India will no longer buy Russian crude, but they also bought a ton of Russian crude, and now there's a certain amount of, well, how much do they have in storage? How much is en route? Do they need any more, given some of the slowdowns that we're seeing on the different market, on the global market? And is this kind of a scheme to put themselves in good favor ahead of what is expected for the price cap? Oh, I'm sorry, the outright ban starting in December, and that's just the access to insurance and ships, with a lot of them being focused in Europe. Then when you look at just where some of the different pivots are, it also comes down to a lot of demand destruction has happened so far, but so is supply. And that's going to be the key, because you're seeing this fight back and forth where demand's gone down. You've seen it, but at the same time, supply has come down. So that's why when you consider the market, we keep talking about it this more like the 70s, where supply and demand are trying to compete on the way down. All the while, total oil product stockpiles, while the deficit narrowed from 48.9 to 48.4, we're in a big problem on the distillate side, globally speaking, which then leads back down to the problems that we keep seeing in terms of where things are going on the export side. What are the impacts in general? How is that happening overall? Because there's a lot of these friction points when you look at the U.S. not exporting distillate, what that would do to the market, and just the gasoline market and the distillate market are so bifurcated right now that you have to look at both together when you're considering what the refiner is going to make, and are we going to see refined, we're going to see run cuts. So when you look at in general, Asia shipped the biggest monthly volume of diesel to Europe in nearly 3 years in September. Diesel loadings to Europe in September were at 306,000 barrels a day, the highest volume since October 2019. And that's when you look at, in general, that's the flow. So you have a lot of this product coming from Asia into the Atlantic Basin, and then it's going to be a matter of where does it get essentially sold into. Does it stay in Europe or get moved to the U.S.? And by the U.S. selling the excess that we have in Pad 3 into Europe, that's again going to take away some of that demand, allow some of that flow that was initially going to Europe coming into the U.S., where we just had two tankers redirect. They were initially signaling Europe. They were now signaling the U.S., which will push Pad 1 imports a bit higher. All the while, shipments of gasoline into the U.S. from Europe were retreated. The U.S. imported 161,000 barrels a day of gasoline during the same period. So again, you're seeing that drop. As we discussed before, the ARB is very hard right now given the price of ships. So even though there's a huge glut in Europe on the gasoline side, I don't want to say low, but we're at the 29-year average, so there's definitely room to bring in additional gasoline into the U.S. That shipping is going to be a hindrance. So then when you look at land storage total, the deficit narrowed from 30.2 to 23.9. West of Suez, the deficit narrowed from 13 to 6.5. And the east of Suez, the deficit widened from 14.7 to 16.1. So when you look at versus 2021, things are starting to move back up, but you're supposed to be seeing builds right now. So the question is going to be, when we get to the middle of November, where are we in relation to normal? So when you look at west of Suez, things have gotten a bit more normal. A lot of that, there's a French refining strike. You've seen some of these buildups in crude in Europe. In the U.S., you've had a buildup of crude in pad 3 with additional flow coming from pad 2, from Canada into pad 2. And you're getting closer back to normal, and obviously you're still releasing from the SPR, which is helping to adjust that, while east of Suez on the Japanese side is a bit lower, but in China and India, you're seeing that rise continuously. And a lot of that can be seen in the floating storage, where the surplus widened from 28.4 to 33.1. The deficit widened from 14.2 to 5.5 in west of Suez. And all of that was driven by West Africa, because we have started to see some of those cargoes start to move into the market, with east of Suez surplus widening from 35 to 37.2. And that's what we were talking about on the east of Suez side. We see that continuing to just grind higher based on Asia, but also the Middle East still has an excessive amount of crude in floating storage, which is some of the discounts that you're starting to see grow between Brent and the Middle East. Crude stocks in the U.S. had a small draw of 1.73 million. That's 26.9 million below the 5-year. But again, that's all being driven by Pad 2 and Cushing. Pad 2 had a small build of 60,000, with Cushing a small build of 580,000. Again, they're moving closer to the 5-year average. And as we've been saying, that you're going to see that continue to grind up and get closer and close that gap as you have a lot of Canadian crude coming down, and you still have the refining capacity problems within Pad 2, which is going to keep a bit more crude in storage. Pad 3 had a small draw of 1.4 million. They're still 15.6 million above the 5-year, while Pad 5 had a small draw. And then when you factor in the SPR, we had a draw of 5.29 million, and that's going to continue with another round that is likely to be announced. Production had a small uplift of 100,000. That's something that will continue to come back in general. So one of the good things that I thought was interesting is when you look at something that Big Orin had put out, and it's a chart that shows the margin of safety in the U.S. SPR. So when you're looking at this, it's what the U.S. SPR what it needs, or what it's over it needs to hold for the 90 days of net imports. So net imports takes into account the difference in crude quality, export light sweet, import heavy sour. And it shows that when you look at shale and the oil sands in general, the SPR is actually in a very comfortable position right now. Now, it just means that we're in a position that there's an ability to put this into the market to try to counter some of the shortages that we're seeing, but it also comes to who is it being sold to? We continue to see the sales. They're going in externally. China has been buying some of it. It continues to move out. But we also have a lot of U.S. crude oil exports in general. And as we've been saying, just given the dynamics, we're going to see something maintaining 3.8 million barrels a day going into the market. And as we're exporting that amount and importing some of that light sweet, though it is, again, lower than normal, we still have a certain amount of cushion or comfort when you're looking at what the SPR has available behind it in terms of this movement going forward. Because if you remember, according to the EIA, they want you to hold 90 days of cover is ideal when you look at where we are. So on a margin of safety level, we remain in a, I don't want to say this perfect world, But again, the U.S. is producing 12.2 million barrels a day, and we can't consume all of it just because of the quality of it, the way we're structured. So that is going into the external market, the export market in general. That enables us to then again bring in some of that heavy sour, that medium sweet, medium sour, and that keeps us in a fairly comfortable spot given what we're producing and what we're exporting, and then that sliver in between. And I know that when you look at some of the different flows in general, like the SPR coming straight down, this, I think, is a really good chart because it goes back to 77. It goes back to where we were at that point in time and where we had different margins of safety. And we obviously had a lot of pickup in terms of where we are, but we also had a lot of refiners coming offline. As refiners come offline, you don't need as much crude because you don't have as much refining capacity. And that's the difference between the utilization rates and the total throughput that is possible that we talked about last week. So when you look at PADD 3, it's, even though we had a small drop, it's the highest it's been since 2020. And then before that, it's the 2022 so far is the highest it's ever been. And we see that, again, being maintained given the production side as well as where this is flowing into. Cushing, as we've been saying, it's going to have that move up. This is typically the point in time that we get builds. So it's not crazy to see builds happening right now. It's always going to come down to the rate of change. And you can see the rate of change is very shallow. Like, we're not getting this huge pickup. Things are fairly stable. And we do see that continuing. We do see a little bit of a tick higher given the increase in Canadian imports, with some of them ending up in Cushing. When you look at runs, the utilization rates fell by 0.4, and all of that was driven by PADD 3 that had a drop of 228,000 barrels a day. PADD 5, we had some assets starting to come back. So we expect that to remain fairly stable in terms of where the runs are in general. Weekly, and even when you look at the utilization rates, and I think it's going to be important with the next chart, even as we're declining along the seasonal norm, you can see that we're actually at a higher utilization rate than we normally are at this point in time, going back to 2004. And even though we're at a higher utilization rate, we're actually at a slightly higher run rate, but not a crazy high run rate when you consider where we are versus historics, just because, again, we don't have as much refining capacity available after the shuttering of some facilities. So even as you have utilization rates higher, when right now we're about 5.9% above the 5-year average, that's only 384,000 barrels a day more than previous years. And that's what I think is the most important thing, is that even at a higher utilization rate, we just don't have the throughput. So when you look at imports, as we said last week, we thought imports were going to stay fairly flat. PADD 1 had a little bit of a bump of 224,000. PADD 2 continues to remain elevated. And PADD 3, it said that it would come down a bit, but still remain fairly elevated. And we think, based on where floating storage is, we will see some of that, another increase in imports into PADD 3 at this point in time. So then when we look at PADD 5 had a decline of 145,000 barrels a day. And when you look at the 5-year average, it was a decline of 265. And that's going to just go back and forth in terms of where those flows are in general. So now when we look at PADD 3, here you can see that PADD 3 imports bumping along the bottom. We see that coming up a bit, but just not a huge amount. It's just, again, going to be well below the 5-year average, but starting to move a little bit closer to the 5-year off that low. PADD 2, as we were talking about the dynamics in Canada and some of the import volumes, we expect this to remain well above the 5-year average and either at new seasonally adjusted highs or at least at the very top end of the range, given those flows and the lack of, even with the lack of refining capacity, there's still a healthy market to bring this crude down, given the differences in storage in general when we are comparing the different regions of the U.S. Implied demand, gasoline had a tick up of 402,000 barrels a day. That's, again, closer to what we've been talking about. As we said last week, 8.3 million barrels a day of gasoline demand was too low. You had Ian coming out, you had some of that makeup number. Now we're back to about 8.68 million barrels a day of gasoline demand. And that's much closer to where we should be. Like, our view is that we're 8.6, 8.7 is the right number to be at this point in time. And that's where it's still below the 5-year average. It's still on the low end, where distillate had a drop of 298,000 barrels a day. That's still, again, elevated, and it's going to come down to when do we get the seasonal bump for heating demand, because as we're going to show you in the next segment, we're seeing that pretty steady drop of trucking demand. And then jet, a little bit below our number, again, 1.45, 1.55 is where we're going to stay. Propane demand had a nice bump of 591,000 barrels a day. A lot of that was just driven based on some of the shifts in regards to, again, demand for heating, demand within the home, because the petchem side still remains an underlying problem. And this just gives you an idea of where we are for gasoline demand over the last 10 years. We're above where we were in 2020, but obviously on the lower end. And as we've been saying, we expect to remain at the lower side of the demand pendulum, as we're going to discuss more in segment 2. Crude oil inventory excluding SPR. We're fairly comfortable. We're above where we were in 2021. We expect this to just follow the seasonal pattern. So we will get some builds, but nothing too aggressive. Like, it's not like we're going back to 2020 levels. It's going to be steady. It's not going to be this egregious move up, but just that very comfortable, I think, steady state as where we are. And we're going to fall right in that cluster that we had between 2018, 2019. That level of comfort is just where we're going to kind of sit as we go into the end of the year. Then when we look at days of supply, that's starting to go up just because crude oil is remaining a bit higher. Refining run rates are coming down, keeping us at a fairly comfortable rate on the days of supply. When you factor in everything, though, again, this chart really highlights the problem that we have on the refined product side, especially the distillate side. And the distillate piece is going to be a big part of what we're going to talk about in the next segment, because you continue to see some of these shifts and some of these policy errors, if you will, that are getting thrown around in terms of how to address it. Gasoline right at the 29-year average. We expect this to continue to move a bit higher, but not an aggressive move up. It's just going to be a matter of where are exports, where are imports, because that's going to kind of be the delta of, do we move aggressively higher? We see exports coming down a bit, imports remaining a bit lackluster versus the 5-year, which will put us above the 29-year average, but again, not at this egregious number like we were in 2020. Then when you look at distillate storage on the U.S. level, you can see that it's the lowest it's ever been. And again, it's being driven by pad 1. So pad 2 is low, pad 1 is low, pad 3 is fairly comfortable. It's a matter of how do you get pad 3 volume into the East Coast and the Midwest. And as we were going to talk, banning exports is not the way. Kerosene at the lows, again, the difference of going into kerosene versus going into distillate keeps things flexible. So we expect the jet side to remain at the low end. And then as you look at the WTI curve, you can see the front months coming down, but some strengthening in the back months. And that's what we've been talking about in terms of the opportunity. It's not so much in the front month, but it's in the belly of the curve, given where the economics are, given where the market is on a demand side and a recession front. There's going to be some of that opportunity on we think on the back end of that curve versus the front. And then when you look at the floating storage on the Gulf Coast, you can see that we're actually coming to the high for 2022, which again comes back to an increase in imports and a bit more availability on the fuel oil side, as we talked about last week, as well as some of that additional crude, with some of it coming from Venezuela. We've allowed Chevron to restart activity. We're getting some additional from the Mayan swap. And then we are picking up some cheaper barrels from West Africa, which is, again, going to keep imports moving higher, still well below the 5-year average, but in a position to see some of this grow over the next few weeks. And again, keeping that pad 3 crude storage a bit elevated. So that's what we have for you on the holistic side. In the next segment, we're going to go deeper into U.S. demand and U.S. refined product backdrops.